Hello, friends. This is Samir Desai from Nippon India ETF team. And in today's session, we will focus on some important criteria which should be considered in selecting which ETF to invest in. This becomes extremely important for investors as ETFs gain in prominence and are beginning to occupy an important place in portfolio construction as well as asset allocation. To help us understand the selection criteria in detail, we have with us Himen Bhatia, who is head of ETF division at Nippon India AMC. Welcome, Himen. Himen, my
Thanks,
first
sir.
question to you is, in the context of traditional actively managed mutual fund schemes, selection criteria are relatively straightforward in the sense that one would consider criteria such as fund manager track record, AMC pedigree, and to some extent scheme AUM expense ratio, etc. However, with reference to passive investing, as the schemes are similar within the category or peer group, this differentiation becomes challenging. Hence, with respect to ETFs, I believe that India has created a simple framework which helps investors, decide which ETFs to invest in. This is, I believe, like a manual or a checklist to help investors decide the criteria for selecting an ETF. So, can you please elaborate on this?
Thanks, Samir. Samir, you are right in pointing out that investors should be aware of the main criteria in choosing an ETF, as many Me Too kind of products are listed on the stock exchange. So we have evolved a simple and easy to understand framework known as VICTER. It stands for V, which is daily average volumes. IC is your impact cost. T is your tracking error. T stands for tracking error, and ER stands for expense ratio. So these four criteria, V, IC, T, and ER, basically these all four criteria should be used in combination for selecting an ETF.
Thanks, Eben. Victor is, I believe, a very simple acronym. So, can you, for the benefit of investors, explain briefly each of these criteria?
Yeah, sure. So let's start out of the four criteria. Let's start with the most simple one first. So first is ER. Okay, ER is nothing but your expense ratio. This is simply the annual fee charged in the fund to manage the ETF scheme, and the expenses which are charged in the fund are within the regulatory limit given by the regulator. Next is T. So out of Victor, we covered ER. Now we'll cover T. T is tracking error. So in simplified terms, tracking error is the standard deviation of difference between your fund's return and your benchmark returns. To simplify it more, I'll break it up. So the difference between your fund's return and your benchmark returns is nothing but your tracking difference. Okay. So you will calculate this tracking difference over a period of time, whatever desired period, say 1 year, on daily basis for 1 year, 2 years, 3 years, whatever desired period. Now, obviously, once you calculate the tracking difference, you may want to see the volatility of that series, right? How volatile is your tracking difference? Similar to how you see the volatility of the returns while you analyze a fund, you see the volatility of the returns, right? Here also, you may want to see how closely the underlying ETF is tracking its benchmark. So the volatility of the tracking difference is nothing but your tracking error in simplified terms. So we've covered ER, we have covered T. So a lower ER expense ratio and lower T, which is your tracking error number, generally is considered beneficiary to the investors. Now we'll cover the remaining two criteria, that is IC and V, and both IC and V must be considered together as one is a function of other. Impact cost and volume generally indicate the liquidity of a ETF on the stock exchange. So to simplify, impact cost is the indirect cost that an investor must bear for transacting in an ETF or a stock for a specified predefined order size at any given point of time as compared to its ideal price. And impact cost is actually a practical measure to gauge the liquidity in the market for a particular ETF or a particular stock. Okay, so generally higher volumes and lower impact cost is considered beneficiary for the investors.
Thanks, Hemant. So, does it mean, Hemant, that all these criteria are equally important and they should be considered in combination by the investors?
Yes, so all the four criteria are critical and important. All the four should be looked in combination. While I say in combination, they all should be looked in relative terms while you are selecting a
Sure.
particular ETF out of its peer group.
Thanks, Hemant. So, I have two follow-up questions on what you just explained. Can you give us a simple illustration of IC, impact cost, to make it very clear to our audience? And my second question is, within the Victor framework, would it be fair to assume that IC, that is impact cost, and V, volume, are the critical parameters?
Sure, Samir. So I'll give you a simple example of impact cost. Now let's take the example of any of a particular investor. Now suppose if an investor wants to buy, say, 1,000 quantity of a particular ETF. Okay, he goes on the exchange and sees what are the best buy trades, what are the best sell trade. Buy trade, I mean what is the best bid price which is available on the exchange, and what is the best ask price which is available on the exchange. Okay, so the ideal price for is the average of bid and ask. So say in our example, he wants to buy 1,000 quantity of a particular ETF. The best buy price, okay, is at 99. The best sell price is at 101. Okay, so the ideal price, which is the average of best ask and best buy and best sell, is 100 rupees. 101 plus 99 divided by 2, which is the average of best ask and best bid. Okay, so ideal price is 100 rupees. Now what will happen is, in order to execute 1,000 quantity of a particular ETF, okay, the execution price came to say 102. Now why that will happen is because not necessary that when a particular investor wants to buy the desired quantity, he will get all the desired quantity at the ideal price. So he will try and if somebody wants to buy ETF, he will try and get the lower. He'll try to buy the lowest price. Then, if he does not get his desired quantity, he will go to the second lowest price, third lowest price, and so on. So in our this same example, the ideal price was 100 rupees. To execute 1,000 quantity, the execution price came to 102 rupees because the ETF was not so liquid. Okay. Now 2%, 102 versus 100, 2% is the impact cost, which is charged, which is not charged, but which is an indirect cost with the investor will pay because of executing the underlying ETF, and the execution price was 2% higher than the ideal price of that ETF on the exchange. So I've tried to simplify impact cost by way of this example. And to answer your next question, are is impact cost and volume, are both these criteria critical? I'll say yes. Both are dependent on each other. So generally, higher the volumes, lower is the impact cost. And if the impact cost is lesser, the indirect cost which the investor will pay for executing a particular ETF, for executing the transaction of a particular ETF, be it on buy side or be it on sell side, that will be relatively lower for an ETF which has relatively higher volumes, leading to lower impact cost.
Thank you, Hemant. So I think this is very similar to liquid stocks and illiquid stocks on the stock exchange, where the liquid stocks will have a lower impact cost for buying and selling them versus the illiquid stocks. So I think this is like a hidden tax that the investor has to pay, a penalty for less liquidity on the stock exchange. So thanks, Hemant, for that wonderful explanation. So my next question to you, Hemant, is we hear this all the while that all ETFs are not created equal. So how do you link this to the Victor framework?
Sure. See, the term all ETFs are not created equal implies that, say, for example, all Nifty 50 ETFs are not created equal. Likewise, you can say that all bank ETF, Nifty bank ETFs, or say gold ETFs, or say ETFs benchmark to Nifty next 50 ETFs are not created equal, and so on for all different category of ETFs. So I'll give you an example that how can Victor framework be used in combination to identify a particular ETF. Now let's take this example. A particular investor wants to buy say a Nifty 50 base ETF. Okay. Now ETF A has the expense ratio of say 5 basis points. Okay. And ETF B has the expense ratio of say 10 basis points. So generally we've seen lot of investors feel that if a particular fund house is managing Nifty 50 based ETFs, okay, all are going to be using the same strategy. They are just going to replicate the underlying ETF. But my example will simplify simplify that understanding that all ETFs are not created equal. Okay. So in my example, ETF A had 5 basis points, ETF B had 10 basis points. So difference between the expense ratio, okay, is 5 basis points. And many times investors get attracted towards a lower expense ratio. Now, if you see expense ratio, you will go ahead and select ETF A, right? Because it has a lower expense ratio. You have to see the expense ratio relative to say the impact cost. So suppose ETF A, which has an expense ratio of 5 basis points, the impact cost of executing ETF A, say maybe 20 basis points. Okay. As against that, ETF B, which has an expense ratio of 10 basis points, say the impact cost of executing ETF B may be simply say, for example purpose, say 5 basis points. Okay. So now if you see the difference between expense ratio was just 5 basis points, and the difference between my impact cost between ETF A and ETF B is 15 basis points. Okay. If you would have just seen the expense ratio and selected an ETF, okay, investor would have been at a disadvantage because 5 basis points is charged only on annual. The difference between the two ETFs, which is 5 basis points, is an annual number. 5 basis point difference is an annualized number. Okay. Whereas the 15 basis points difference of impact cost between ETF A and ETF B, okay, you will keep paying 15 basis points, which is the indirect cost, every time you execute the transaction in ETF A. So as we rightly discussed in our previous conversation, impact cost, I'll say, is a hidden cost which the investor pays for executing of a particular ETF. And it is simply basically if simply investor goes ahead and selects ETF based just on the expense ratio without considering other parameters of the Victor, say in our example expense ratio and impact cost, he will end up paying more basically in long term as compared to if the investor would have selected an ETF on relative terms. While I say relative terms, he should consider all the factors which are part of the Victor framework.
Thank you, Hemant. So I think this is very important what you just said. There is always a common misconception that what is sasta is necessarily sundar, which is not the case here. A lower expense ratio doesn't necessarily mean that the ETF is always better because that advantage can get negated by the impact cost. So thank you, Hemant, for explaining this. So this is a wonderful, I think, checklist, which is formulated by Nippon India. The Victor framework should always be kept handy by the investors before deciding which ETF to invest in. So, Hemant, any closing remarks from you?
So, Samir, I would like to conclude by saying that Victor as a framework is very critical for any investor to select an underlying ETF within the same peer group. Okay. But any of the four factors which constitute Victor framework should not be looked independently, and hence they should be looked in combination to each other so that investors can make an informed decision while selecting a particular ETF within the same peer group.
Yeah. Thank you, Hemant. So this was really wonderful. Thank you for educating investors on this simple framework. The checklist will indeed help investors immensely in selecting the right ETF. And most importantly, Victor is very easy to remember. One just has to remember V for victory and it is very easy to recall the VICTER framework. So I will just conclude by saying that just as Budget 2022 provided Gati Shakti to India, the VICTER framework is an important framework which provides Gati Shakti to the ETF. So this is a very, very important, framework. The combination of factors is an important checklist that investors should always look at and keep in mind. So with this, we will end this session. Thank you all for joining in, and have a safe and healthy year ahead. Thank you, Hemant.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.